Hello and welcome. Today we are diving deep into a stock that, let's be honest, has been on an absolutely incredible tear, NVIDIA. We've got our hands on a professional technical analysis and we're going to break it down together, piece by piece, to figure out what the charts are really telling us. So let's jump right in. So let's start with this number, 39.6%. Just let that sink in for a second. That's the gain NVIDIA has posted in just the last few months. It's a huge number, and it really captures the incredible power and momentum behind this stock. And honestly, it sets the stage for everything else we're about to talk about.
All right, so first things first, we have to understand the bigger picture here, which is this powerful long-term upward trend. To even begin to guess where a stock might be heading, you've got to respect how it got here in the first place.
And this timeline really tells the story. I mean, look at this. Back in July, it was sitting at a low of around 138. From there, it just started marching upwards. You see that massive spike in trading volume in September? That tells you a ton of new interest poured in, which then fueled another huge surge, bringing us to where we are today at 192.57.
And make no mistake, this isn't just some flash in the pan. The analysis is super clear on this. The underlying long-term trend is rock solid. One of the biggest indicators analysts look at is the 200-day moving average. Think of it as the stock's long-term baseline. Well, that baseline is way down at 144. The fact that the current price is floating so high above it, that's basically the market screaming that we are in a very, very powerful uptrend.
Okay, but here's where the plot thickens. Despite all of that amazing, positive momentum we just saw, this professional report kicks off with a medium confidence sell signal. So what on earth is going on? How can both of those things be true? Well, let's dig in and see why the analysts are suddenly tapping the brakes.
And this slide, right here, lays out that conflict perfectly. It's really a tale of two completely different stories being told at the same time. In one corner, you've got the bulls, pointing to that strong trend and all the investor interest. But in the other corner, you have the cautionary case, and they're pointing out that the stock is getting close to a ceiling, it looks a little stretch, and most importantly, several indicators are flashing overbought.
So let's look at the evidence for this caution piece by piece. First up, we have something called the stochastic oscillator. Now, you don't need to know the math. Just think of it as a speedometer for a stock's momentum. And right now, that speedometer is in the red zone. It's suggesting the stock is overbought, which is just a technical term for it might have gone up too far too fast.
But hey, one warning light on the dashboard isn't always a crisis, right? So the report points to another tool, the Williams R indicator. It works a little differently, it measures things in a slightly different way, but it's telling the exact same story. So now we have a second, totally independent gauge also saying, hey, things are looking a little overheated here. The case for caution is definitely getting stronger.
And just to really hammer the point home, we have a third one, the Commodity Channel Index, or CCI. And guess what? It is also firmly in the overbought zone. Now, this is the part that's really crucial. It's like going to 3 different doctors, and all of them give you the exact same diagnosis. When you see 3 separate, independent tools all flashing the same warning sign, that's when analysts really sit up and pay close attention.
And here's just one more way to visualize it. Based on a purely statistical look at its recent trend, basically where the trend line says the price should be, the prediction is about 183. But look where it's actually trading, all the way up at 192. That gap between the prediction and the reality really reinforces this idea that the price might have gotten a little ahead of itself, or as the analysts say, it's overextended.
Okay, so we've got the big picture, right? Long-term strength is clashing with these short-term warning signs. So now, let's get practical. Let's translate all these ideas into actual concrete price levels that are going to define the upcoming battle between the buyers and the sellers. These are the numbers to watch.
But before we look at the numbers, you have to understand 2 really simple but super important concepts: support and resistance. The easiest way to think about it is this. Resistance is a price ceiling that's historically tough for the stock to break through. And support is a price floor that's historically tough for the stock to fall through. These are our battle lines. And here they are in the chart. Now, the most important number to watch right now is that resistance ceiling at 195.30. I mean, look how close the current price is to bumping its head on that ceiling. Meanwhile, the strongest support floor that the report identifies is way down at 181.60. So you can clearly see the stock is knocking on the ceiling, not resting comfortably on the floor.
So, with these battle lines clearly drawn, the whole analysis really boils down to 3 possible scenarios, 3 potential futures. This is where all that data we just looked at comes together to paint a picture of what could happen next.
First up, the bullish scenario. This is the one where that powerful upward momentum just can't be stopped. The price smashes right through that 1953.0 ceiling, and what you'd want to see is a lot of trading volume on that move to prove it's for real. If that happens, the next stop everyone will be watching is that big, round, psychological number, 200.
Okay, scenario number 2, the bearish case. In this version of the future, that ceiling at 195.30 holds strong. The stock tries to break through, but it just can't do it. This is where those overbought signals we talked about could kick in, traders decide to take some profits off the table, and the price starts to fall back down to test those support floors, first around 187 and maybe even down to 181.
And then there's the third possibility, which is basically a stalemate. The stock isn't strong enough to break the ceiling, but there also isn't enough selling pressure to really push it down to the floor. So instead, it just kind of gets stuck in a range, trading sideways for a while. This lets the market catch its breath, digest these massive recent gains, and basically wait for the next big piece of news.
So, we've weighed the long-term trend against the short-term warnings. We've looked at the battle lines and the 3 possible scenarios. So what's the final verdict? What's the one big takeaway from all this? Let's synthesize everything into a single conclusion. Here it is, boiled down to the essentials. First, the big picture is still great. That powerful uptrend is fully intact. But, and it's a big but, the short-term picture shows signs of exhaustion. It's overbought. This means the risk of a little pullback or just some sideways trading is definitely elevated right now. And it all hinges on that one key number, 19.5.30. That's the level to watch. And so this entire analysis really leaves us with one key question. You have this incredibly powerful long-term story that's colliding with some very real short-term headwinds. So the question isn't really if NVIDIA is a strong company. The long-term trend shows that it is. The real question this analysis poses is all about timing. When is the right moment to make a move? And that is the puzzle we're left to think about.